Kia ora, my name's Jess. I'm from the External Communications team here at the FMA, and you're joining me for another episode of Jess Learns to Invest, where I chat to you all about investing. Today we're going to be talking about market volatility, what it means, and how it can impact your investments. I'm really excited to welcome Brad Olsen to the podcast today. So you are the principal economist at Infometrics.
That's the one.
And I believe quite a few people probably have already heard your voice before because you do quite a lot of speaking engagements. I, for one, found out about you from Fletcher Ward & Haley, and they like to call you Bad News Brad.
Yes.
And I'm hoping we can change that today and you're going to be Good News Brad. Yeah, let's hope you can give us some good news.
I'll try.
Volatility.
It's tough in this role. I mean, economists are called, economics is called the dismal science. So it seems true to reason that I'd be someone like Bad News Brad. But there's always, I think, some useful information amongst the bad news.
Yeah, hopefully we can spin it into a positive. So whenever I start these episodes, I really love to know your background, especially when I meet someone who's like similar age to me. I'm always fascinated. How did you get into your investing journey as well, and then just a little bit about your career and your background?
Definitely. I mean, in terms of investing journey, a lot of that came through from my grandparents. My grandfather and grandmother, they had some shares at various points. So did mum and dad, just sort of dabbles in bits and pieces. But it was a conversation we had often, over the weekend or around the dining room table. Mum worked for a bank at the time. Dad was a builder. So just these sort of conversations around money and sort of how it worked for us was always pretty constant. Sort of not super detailed, but we'd be watching this sort of stuff. To be fair, I was also a nerd from fairly early on. I think at intermediate school, I spent 2 weeks at the start of the year writing down stock market prices from the TV news every night in a little notebook.
That's impressive.
I was keen, right? Obviously. So all of that, I mean, I realised pretty quickly that money and the numbers were important, and so if I could understand them, then hopefully I'd have a bit more information on which I could base better decisions, and that's sort of true today. Also where the economics sort of journey came from. I moved down to Wellington to train in economics, to do my degree down here at Victoria University of Wellington. Had no idea what I was going to do for a job. Thought I'll get the degree and then figure it out.
Yep.
Like everyone,
yep.
Right? And it was an interesting one because I got this work experience at Infometrics. Very small team, been around 40 years now, and so it sort of has been a long journey. Not for me personally, but for the entire company. We've always been quite forthright at giving out our hot takes on the economy and what we think it means, sort of without fear or favour. No one tells us what to say. We're highly, fiercely independent in our view, and that was quite attractive for me because this sort of stuff is important, but I think that sometimes in the finance game we're often a bit too guarded with the big words that we use to try and sort of make everything too confusing. So I was quite keen to cut through that, and I feel like I've achieved that quite a lot the last couple of years.
I love that because it just goes straight over your head, and my experience growing up was very different. I don't remember, my parents did teach me a lot about money, but I don't remember investing ever being a conversation. And really it's only in recent years that I've started to think about it. So I think it's a good messaging to remind people that you can start at any age as well, which is what I really love about having these conversations.
Exactly. Well, and also back, when we were younger, you couldn't invest. It wasn't particularly easy. And that's actually one of the memories that I have going in with my grandparents. They wanted to, I don't know if it was to buy or sell some stocks, but they had to go into an investment broker. And it was a it was a whole day thing. We had to drive into town. We had to, go and meet with these people. There was all this paperwork to do.
Yeah.
I mean, it was very labour intensive. And of course, you could probably only do it with a certain amount of money. And at that point, my grandparents had a little bit that they've been saving up over time. But I also remember the person who was doing it for them gave me a little investment book that I did have a read through. Cool. But, in recent years, you have actually been able to do it. I mean, I could do it on my phone right now.
You can do it online, right?
Through this entire podcast, I could be sort of share trading. To be fair, I think that's also a little bit, not dangerous, but people do fall into a bit of a trap when they start talking about investing. They think that they are someone on the floor of the New York Stock Exchange with three phones their ears. And
that's not for me. No, sounds too hard.
and on that option, it totally is too hard. I think that'd be awful. I couldn't make those sort of picks. But when you're thinking about that sort of longer money journey, it's more about, how do you make sure you get your money to work best for you? Because by the time retirement or anything else rolls around, you're trying to get a house deposit or anything, you can't sort of make the decision on the day to do something with your money. You've got to let it build up over time.
Point. Yeah, it's all about that long term, hey? And so today we're going to be specifically talking about market volatility. It's a term that is just wasn't around at the moment. And it is a word that kind of makes me freak out a little bit. I think it's the volatile part that I'm like, it sounds like a big scary word. Can you explain what it is?
The simplest way, I think, to put market volatility is how much prices go up or down, just how much they change, and sort of how quickly as well. And it's both of those, I think, that are important. Now, often when we talk about market volatility, if you've got some shares, for example, you don't worry as much about volatility on the upside. If it makes you lots of money, you're pretty happy, right? It's on the downside that people worry about. They buy something at a certain price, $10 a share, let's say, and then if that price is volatile, it goes up to 12, people think, oh, that's quite nice, I've made some more money. Then it crashes down to 7, and you go, whoa, I just lost a whole bunch. How did this happen? And so it's changes are uncomfortable to start with, but it's the uncertainty of if it's gone from 10 to 12 to 7 in the space of 4 seconds, you just completely lost the plot. Who knows what's happened? What's driving that? It just feels really uncertain. It feels too quick. You're just sort of a little bit too worried. And that's completely normal because there is so many of those changes. Especially, the last couple of years, there have been times of great volatility. You look at the likes of start of COVID-19. All of a sudden, everyone went, well, I thought that everything in the economy was worth this much. And then all of a sudden, COVID came through. The markets quite rightly generally go, oh, there's something bad coming. I'm just going to sort of hedge my bets, I'm going to wait and worry a little bit more. Share prices generally come down. It's that volatility where sometimes it can go down a lot and then recover a bit. And I think the main challenge with that level of volatility is the uncertainty that comes from it. You're not quite as sure if it's going to go up, if it's going to go down, where it's going to move next, and probably most importantly, why. Sometimes you look at some of these movements in the market volatility and you can understand that, something bad has happened for a company and now it's worth less. But sometimes something bad or weird has happened in the economy in general. No one knows what's coming next and everything just flips around like nobody's business. It feels like a roller coaster ride.
Interesting, because for some reason I just assumed it just meant it was dropping. But it means both, that it's the change.
Technically, but let's be real. I mean, no one really cares, right, when it goes up. Everyone feels quite comfortable.
It's when it's down there.
Until it falls. Well, and that's the other thing. I mean, even the last couple of years, and I often talk to friends about this, they bought something, say, at $100. It became worth $200. That's their new reference point. They only think of the 200.
Right, yeah.
Comes down to $190. They've still made $90 from wherever they were, but they feel like they've lost 10.
I get you.
So it often, I mean, volatility is technically on both sides. It's just that most of the time people worry about a lot more on the downside because it means that they either feel like or sometimes they have lost some sort of value.
And how is it typically measured?
It's a great question. I mean, in our minds,
because I'm terrible at maths and stuff.
I think probably the easiest way, one of the common measures is that they use sort of formally on the stock market is the VIX, which is sort of a volatility index.
Yes.
And basically what that does is they try and measure out or look out for the next 30 days or so, what are the market traders, the people with all their phones to their ears, what do they think the volatility is going to be like and sort of how worried are they? It's sort of, think of the volatility risk a little bit like the worry matrix. That's the sort of thing that people are going, how worried, how cautious should I be? Could it move bigly in either direction, or is it going to sort of just gently move a bit more? If there are big changes, if it's whipsawing up, then down, then up, then down, you don't know where sort of left or right is. If it's just making little movements, you feel a little bit more comfortable. And so generally what the VIX does is it looks at where are people thinking prices will be in the future and just how variable does that look. And so I think probably for a lot of people when they're concerned about volatility, it's how much are your investments changing day by day or week by week. If it's changing just a constant amount, if it's always going up just a little bit over time, or even if it's going down a little bit over time, at least you generally know what path or direction it's taking. If it's moving hugely every day, if you see something up 10% one day and then 12% down the next, you're going, whoa, I don't know what direction this is going to go next.
Yeah.
So it's the magnitude, I think, of the change and the fact that it's going from one direction to another. That's where that volatility comes in the most. And
how can that impact someone's investments? Because from what I know, from what I've learnt so far, is looking at it every day is not a great thing, right? No. So how does market volatility impact people's investments?
Often what happens when we see periods of market volatility, a lot of investors, especially retail investors, they get worried because all of a sudden it looks like generally they've lost money. Like that's the fear factor, right? Is you go, I put my money in, now it's worth less. And I think one of the instant reactions that people have is, I don't want it to get even worse. So I'll take it all out now. I want to get rid of that risk. I'll sort of pull it out. And often, when we've seen this over time, it depends a lot on what you're wanting your money to do for you, but there is a risk that if you take it out all at once, you may well just lock in what was previously just a paper risk. To give you an example, we had, let's say that you had a share or something worth $100. Bit of volatility over sort of the course of 3 days. It goes from 100 to 200 to 150 down to 90. Now you're going, whoa, this has sort of moved hugely the last couple of days. I'm worried. I'm going to take it out. So you take it out at 90. You've lost $10. Let's say the next day it goes up to 400. Then all of a sudden you're going, well, I just lost, I lost the opportunity to make 310. What's going on there? And so that sort of level of, there's this sort of risk element where people, I think, often go, I need to cut my losses and sort of move it out. And it depends on your investing strategy and most importantly, your risk factor. Now, personally, I'm not going to retire for a good 40 years plus. I don't need my investments to be usable tomorrow. I don't need that money right here, right now. So personally, in my risk factor, I go, just let it be. I'm happy to sort of let it go because we know that time in the market, how long that investment spends there, is generally going to make me better returns than me trying to be a real smart picker and go, this is the right time to buy or sell. That generally doesn't work out all that well. The difference, I think, is that if I was someone who was coming close to retirement age, I need my money quite soon, or I'm wanting to use it for a home deposit, I don't want to have, say, $5,000 worth of money in my investments, and then all of a sudden, I say to the bank, hey, look, I'm ready to give you $5,000, I'm ready for that home deposit, and then they come and say, cool, yep, you're ready to buy, and I'm going, oh, geez, my investment's only worth $4,000 now, and they're saying, well, you can't buy the house. So I don't want it to be too volatile often if I'm going to use it soon, and so that's often where you see the different types of funds and risks come through. If you want it in a high growth fund, then you're sort of willing to take the risk. In my case that I am, it could go up or it could go down quite a lot, but I'm happy to sort of take that through. Or at that lower risk end, it might be sort of more of a cash fund or similar. It's not going to grow as much, but it's not going to fluctuate as much either, is the probability there. And so it really depends on what you want your money to do for you, what that risk factor is as to how keen are you to sort of almost not risk at all, but be willing to have a bit more risk than before.
And I feel like you've kind of already answered this, but it sounds like it impacts short-term and long-term investing differently.
Definitely. Based
on your strategy. So should people who are short-term investing, is it something they should be worried about?
I think probably for short-term investors, they are looking or are going to be looking a lot more at that volatility because they're a little bit more worried about sort of how quickly could things turn around. Do they need to cut their losses or not? In terms of, are these fluctuations being driven by something that's generally fluctuating lower, generally fluctuating higher? Do they need to get out or change their position? For longer-term investors, it's a whole different ballgame. For a lot of people, it's probably not, for many, worth doing all that much about it. I think, again, you look at the likes of the start of the start of COVID-19. I had a lot of friends that were messaging me at the time, they're like, stock market's down, everything looks awful, there's a lot of red ink, what do I do?
Oh man, I feel for you, that would have been a hard time, everyone wants your advice.
It was so tough, and I remember thinking, I don't know what's happening, and I'm sorry, the best minds in the world don't have any clue at the moment. But I remember saying to them, I was like, look, if you hadn't have looked at it, you probably wouldn't have figured it out for a couple of months. Now, there were some people who, again, they changed their funds, they changed whatever their investment style was, and they probably lost a fair bit of money. Now, you look at where the markets were probably about 3 months on, it had recovered all that space. So I didn't need the money then, I didn't need the money in 3 months' time, I just sort of let it work through. I think it's more that if you're in that short-term investing stage and you are sort of looking at needing the money in a quicker sort of period of time, that's where you want to already, I think even before, you don't want to wait for volatility to hit, you want to be making that decision earlier on. And if you are cautious, you are nervous about sort of investing, I wouldn't jump straight to the high-risk option. You want to sort of start in easy, have a figure out, and that's what I often sort of see friends do. They're not sort of putting their entire life savings into the investment market. They're putting $50 in, just having a play around. And I think the best advice my grandfather always gave me around investing is don't sort of invest anything that you're not willing to lose. Like, I'm not putting my daily rent into there. I'm putting the sort of future savings. I'm willing to let it fluctuate a bit. I'm comfortable with that risk. But as I get closer to retirement, as I got closer, if I was going to buy a house or something, I wouldn't leave it in that big high risk option. I wouldn't be willing to sort of trade off the growth and the risk. I'd be going back and saying, look, I don't want it to move much. I'm happy to take maybe a smaller amount of money, lower growth, but I'm also keen for it to sort of stay here rather than whipsawing between the bigs and the littles.
Yeah, that makes it really understandable for me. Like, I just like how you explained that. Like, yeah, very different, and you can change your risk level depending on when you need that money.
And that's the big one, right? Like, you don't have to sort of lock in one investment strategy and that's the only thing you'll ever do in life. It's like a job, it's like a house. You will change depending on your circumstances. You wouldn't do the same things if you were renting as you would if you had a partner and kids in a house. You know,
totally.
if you're a worker in a grocery store, you wouldn't sort of do and spend the same way as you might be if you were a farmer. You know, the needs and wants, what you've got to do with it is completely different. But I often find that people come in, they do it. I mean, I've got randoms on the street that come up and say, what should I do with my money? And my question that I always go back to them is, what do you want your money to do for you?
Yeah.
Because that matters a lot. If you want to sort of go hard and risk it all and you want lots of money all of a sudden, then you're going to have to sort of take quite a lot of risk. It could pay off, but it could all fall apart. If you're going, hey, I'd like quite a comfortable lifestyle in the future and I'm willing to start quite early to get there, then that sort of also sets them in motion for a certain type of investing, or just sort of figuring out where they want their money to go. Because I feel like too many people try and look at what everyone else is doing and saying, I'm going to do that because that's what Joey is doing. Don't do that. Joey's got a different lifestyle to you. Pick your own path.
That's why that research and just like, and it's not that you have to know everything, because otherwise you might never start. Like, that's me. Sometimes I would feel like I need to know everything before I do anything. But it's like just doing a little bit of research to understand that, because initially I was like, oh, it's not for me because I'm not mega rich. And now I'm learning, hey, I can put $10 in. It's actually, do a bit of a budget. And if you've got a spare $10, $20 a week, you can put that towards investing.
Definitely. I also feel like you feel a little bit more connected to what's going on there, but you do have a bit more of a vested stake in how the economy's running, how those businesses are going. Sometimes, and we've seen that the last couple of weeks, you can't change as much of it yourself. You don't have as much direct control, but that's also where that sort of investment strategy comes in. You're investing in specific companies, in which case, do you know about that very specific company, or are you better to sort of think a little bit wider? Depends again on your risk tolerance and what sort of information you have. And for a lot of people, you're right, you don't need to know everything. And to be blunt, anyone who tells you that they do know everything is just all talk. I mean,
it's always changing, right?
Absolutely. We've got no idea what's happening next. We've got a pretty good idea of some of the fundamentals and where they think they're going in the future, but that can all change in an instant. And that's where, again, that risk profile comes through. If you're willing to have a bit more risk, sometimes you can get a greater reward, but there's equally that chance that it might fluctuate a bit more. If I'm willing to or if I'm not keen to sort of see that same level of risk, I'm happy to take maybe not as big of a return, but be a bit more stable, then that's also completely fine. And oftentimes people will move between them depending on their life stage.
And I like what you said earlier about, don't do what Joey's doing. Like, I feel like a lot of the time when we panic, we do just, if we feel like we just got to follow the crowd. So do you have any tips for investors on what they can keep in mind when the market is coming down before they react emotionally? What can they keep in mind?
First one, take a breath. Like, it's happened. You cannot change what happened in the past. If if you're looking at the markets and you're going, all that money has already changed, hoping that it won't be there in the morning is probably not really a good strategy. It's already happened. So you've sort of got to be a little bit blunt with yourself that, look, it's changed, but also take that breath, because what you'd hate to do is make a rash change because you were worried, because you were super emotional about it, which is a very normal, very human response. But if you jump into that, then you'd hate to be in the same position the next day where you go, why did I do that? I didn't think it through.
Yeah.
And so I think the biggest thing is take a breath, take a pause, figure out, again, go through that sort of checklist of, well, what do I want my money to do for me? Am I happy enough with the risk that I'm currently in? And if I'm not, let's go and talk to someone about it, because I probably need someone to bounce off.
Point.
Firstly, there's very much like professional advisors, and I think that's always a very, very smart move for people to make when they've got money that they need to move around. But also have a chat to a few other trusted people. Don't take what they say as gospel, but just bounce ideas. You want to be knowing, am I right, sort of asking the right questions? Have I thought about that particular point? Is it relevant to me? And I think at the end of the day, when you go through all of those, you'll just feel a lot more comfortable that when you make a decision, there's always uncertainty in the world. At least you've gone into that decision eyes wide open, rather than having to blind react, make a change, and then maybe regret it the next day.
Good point to chat to someone, because that'll help ease some of that stress as well.
A problem shared is a problem halved.
Yeah. And there's people that are well educated about this type of thing, so they're the people to go to.
Yeah.
And this might seem like a silly question, but I just thought of it as you were talking. Does market volatility impact all types of investment, or does it impact them differently?
It does. I think it does impact everything, but it impacts it differently depending on what we're talking about. I mean, we'd be talking about the housing market volatility the last couple of years for New Zealand. Yeah, I mean, house prices shot up 30% over sort of 21, 22. then they've come back like 17. So yeah, that's been a volatile market. I think different though when you look at in terms of time period, when you look at the likes of, investments in the share market and similar, and again, different between different areas. The New Zealand share market versus the US share market versus the Australian. All will have slightly different movements, depends on interest rates, depends on a whole bunch of other topics. And then you've got, other things. You've got commodities, you've got, if I was buying, I don't know, gold, heck, at the moment, if I could buy, olive oil futures or chocolate futures, those prices have massively changed.
Olive oil is like gold.
Exactly, crypto, all those sorts of things. It depends. There's so many different drivers that can often mean that if one thing's moving, something else might also be moving, but it might be in a different way. It might be led by different things. So there's always a bit of volatility out there. I think there's almost two stages of it. One is just normal, let's call it day-to-day volatility. There's always a bit of up and down. But I think it's when you start to get those very big movements, that's when people really start to worry because the numbers look bad. Your investment's lost 10% or it's made 10% and you're just starting to spin out and go, I feel like I'm on the really sort of topsy-turvy bit of the roller coaster. I'm not sure what way is up or down. It just makes everyone feel nervous because they're so much out of control. When things are sort of moving just a little bit here and there, people feel a little bit more in control.
So is it important to be well informed when there's market volatility? Or because often for me, I feel like if I looked into it, like reading all the stuff at the moment, that makes me more nervous.
Yep.
So would you say it's good to be well informed, or is it better to kind of, as you say, depending on your strategy, leave it put, don't read too much into it?
Probably depends both on your strategy and also your personality. Look, I mean, I'm a news junkie. I love to read all the stuff. Even though it might not personally affect my investments or what I'm going to do with my money, I like to feel in the know. Equally, some people are going to be very happy with putting their heads in the sand and going, la la la, don't tell me anything, I don't want to know. Again, if you're a sort of a short-term trader, then putting your hands over your eyes and hoping that you can't see anything, probably a bit of a challenge. If you're that longer-term investor and you're not worried about the sort of short-term fluctuations, then that's maybe a viable strategy. I generally think as an economist that it's always good to have a bit of information about it, but if you're reading absolutely every single thing that's coming through on the live ticker or whatever, then you're probably a little bit, maybe going a bit over the top, but having a little bit of knowledge about what's driving it, I think that can start to help you just understand what is driving that shift, and then also going into that assessment of, hey, do I need to change? Oftentimes the answer to that might be no, but it's not a bad thing to just have a healthy check-in every now and then and go, hey, markets have done these things. Am I still broadly cool with that? Am I feeling too nervous that I really need to change? Or am I going, yep, I'm nervous, but actually I'm happy enough to stay the course? Having a bit of information about what's driving those changes, I think will, again, just make you comfortable enough that you're making the right decision. But equally, like I say, going too deep into it and sort of spending every night sort of scrolling all the overseas news sites, it doesn't do anyone any favours.
And what is the best way to manage market volatility in a portfolio?
I think probably the biggest one is a bit of diversity, and that's classic in life. If you've got everything in sort of, one camp, if something happens, anything happens to that camp, it's going to look pretty bad pretty quickly, or it could. Whereas if you've got things spread across a bunch of different areas, then you sort of protect yourself from any one thing being hit. And importantly, it means that if there is a big event overall that hits everything, you're in the same boat as everyone else. It's not like anyone else is in a particularly smarter position. So if you've got that sort of spread, you make sure that you're not sort of exposed to any one particular specific hit or threat or challenge or volatility, if you've got it a bit more spread. And I think also that's where we often find that people are looking at, often letting the market do its business a bit more. You find people that are keen for index trackers or similar because they don't have to do that hard work of, having a massive spreadsheet and going, I'm going to buy 10 of this, 20 of those, 30 of those, 10 of those. It's a lot of admin.
Yeah.
And admin is something I don't have time for, and most people don't, right? I mean, you'd be the same. You don't have time to go and choose all the markets.
No, also, it's just so confusing. I'm like, how do you choose as well?
Exactly. And I think that's the risk, is that also you then get into this sort of level of, well, I don't know how to choose. I don't know the right information. Oh, it's too hard. I just won't do it.
Yep.
And that's also, in a sense, not the best option. Whereas if you can find a bit more of a middle ground and sort of work through it and let you look at some different options, that's important. But I think that's why as well we often see that people try and have that diversity, not only in terms of their share portfolios and similar, but also other investment classes. Anywhere from, you might want to have some money in the term deposits. You might think about buying housing. You might think about commercial property. You might think about gold. Like, there's a whole whole lot of options out there. But I think also part of that comes through, one, again, going back to what you want your money to do for you, but also two, how do you need that money to be working? Like for some people, they'll want to have a little bit of emergency money in the bank that they can draw on immediately, because if your car blew up tomorrow, then you're probably going to need to do something like right quick. You might have a little bit more money in your emergency sort of rainy day account. It might be in sort of a term deposit. Pretty safe in general, but also the sort of thing that you can't get at immediately, but it's quick enough to get at if you need it shortish term. And then there's other things that, might be really hard to convert into cash if you needed them, and those are often your longer term assets. So variety is sort of the important one here, I think, in terms of having that diverse spread.
And I feel like with the situation at the moment, I feel like we have to sort of talk about the US a little bit. I keep hearing the term tariffs. Is that how you say it?
That's the one.
I don't really understand what that means, but all the headlines are talking about tariffs. So this is kind of a double-part question, because I want to kind of know what tariffs means. And then, again, this part might sound dumb, but KiwiSaver is New Zealand specific, right? So why is the situation in America impacting our KiwiSavers?
Yep. Both
that makes no sense
questions.
to me. I'm like, why?
Well, and honestly, if you're asking it, heaps of other people are either wanting to or actually asking it as well. Let's deal with tariffs first. Tariffs are an import tax. Basically, if I'm buying something, let's say that I'm a US consumer, I live in California. I'm buying something off Temu from over in China. It's $5. Now, that item, if you put, say, 100% tariff on it, it means I have to pay 100% of that value of whatever item I'm buying in to the government. So I get $5 for the pen that I'm buying, now have to pay $5 also to the government. So overall, my pen has now become $10, split in half between that and the tariff. And so what we've seen in the US is that President Trump has levied a bunch of tariffs across the world. They're always changing at the moment, so we won't say exactly what they are because it'll change in an instant. But that level of tariff that comes through means that you're seeing a lot of businesses, particularly in the US, they're going, oh gosh, a bunch of consumers, if I'm going to buy in stuff from overseas, then I'm going to have to pay a tariff on it. So if, for example, I'm a US car manufacturer, I'm going, crikey, that sort of wheel that I'm going to buy in to put on the car, it's now going to cost, 10-20% more. Now, if it's 10-20% more, there's either of two options that I can do as a US company. Either I can push that price on to the consumer, so if you're going to buy my car, it's going to cost 10-20% more. Or, as a business, I can say, look, I'll sell the car to you for the same price and I'll absorb that within my margins. The reason that then affects markets is because markets are looking at the value of these companies, right, and going, well, if the motor car company over here, previously it sold $1 million worth of stock, if it's going to sell, or if it's only going to make $900,000 worth, probably it's worth less to me. I'm not going to give it as much money. I'm not going to sort of value that share of that company at the same price, which is why you're seeing a bunch of companies, particularly in the US, that have lost a lot of money. We know as well there are some specifics there where some of the supply chains for big US companies, they source a lot of their stuff from overseas. So all of a sudden, buying all of that's going to become a bunch more expensive. Now, I said just at the start of that question that tariffs are an import tax.
Yes.
That's important because it means that the consumer pays it, not the person who's sending it. So again, it's the US consumer at the end of the day who will pay for it, rather than if I'm shipping some clothes or something from Vietnam, the shipper doesn't pay it. It's the person when it lands in the US. And again, that sort of comes through because it means that the US is being hit first and foremost. In the US economy, what's becoming a bit more true is two things. One, it looks like businesses won't be making quite as much profit because those tariffs are soaking up a bit of money. At the same time, if those tariffs do lead to higher prices, then the US is going to see some more inflation. And we've seen the last couple of years that the Federal Reserve in the US, very much similar to New Zealand's Reserve Bank, when they see high inflation, they get worried. Inflation is generally a bad thing to have at a higher rate. And if that happens, then generally speaking, you would see interest rates set by the Federal Reserve in the US, the Reserve Bank in New Zealand, would push higher or maybe not drop down as much. And so all of that's leading into a position where everyone in the US markets are going, well, hang on, I don't think that business is worth as much as it was the day before. Now, how does that affect New Zealand KiwiSaver? You're right that we're not directly in the line of fire, but most New Zealanders and their KiwiSavers do have investments going through the US or based on some US companies. And that's because we know that the likes of the New Zealand economy, the businesses that we've got here at home, They're not necessarily big enough to sort of look after everyone's money. There's sort of not as many investment opportunities. We don't have an Apple in New Zealand to buy into.
Yeah.
So if I want that sort of exposure, then I will get my KiwiSaver fund, or I'll do it myself. I'll buy into something like that. And so it's that exposure that we've all got going into the US. Now, the US is the sort of financial hub for the world. It's where a lot of those big investments go. It's where a lot of the money eventually tracks back to. We transact a lot in the US dollar. So like the US economy is pretty big in the financial field. And so at the moment, with so many people, institutional investors like the big guys, the big banks, the big funds, but also retail investors, you and me and everyone else, when we're putting our money, often people have got a fair amount somehow either directly or indirectly linked to a US company. And so as those US companies, they start to be worth less, that means that our investments also start to be worth less.
Because KiwiSaver is kind of set up for you. And I would have had no idea that in the background it's linked to US companies. Totally understand if you're buying shares in a company in the US, and I can see how that would impact you. But with KiwiSaver, I was like, I just don't see the connection.
Yeah, it depends as well on what sort of KiwiSaver you're in, and you can sort of choose that right as you go around. Often the last couple of years, you see that a lot of the growth in markets has been coming out of the likes of tech stocks, all the technology, all the services and similar. Again, New Zealand doesn't have huge numbers of those. Most of those are headquartered in the US. So if you're an investor, or if your KiwiSaver manager wants to have a bit more exposure to that, because you've said, yep, I'm keen on that sort of growth stuff, then you need to somehow buy it. You can't buy it in New Zealand. You can't necessarily buy it in the US, in Australia rather. So you go over to the United States. You get it from there. Although at the same time, you might well have some KiwiSaver managers or some different funds that, they're a bit more conservative. They're not looking for as much growth. They might be buying other stuff. They might be buying properties, or they might be buying just cash assets or bonds from government. So depends on exactly where your money is. Basically, it's what you generally see with a lot of KiwiSaver is that they've generally got some sort of exposure to everything. We talked about, having a diverse portfolio before. It depends on how big that sort of US share is. But even then, if you look at the likes of New Zealand investments, they've also come down a bit. And that's because everyone is going, well, if the US, the world's biggest economy, isn't doing quite as well, then they're probably not going to be able to spend quite as much on New Zealand companies and New Zealand exports.
Yeah.
So if that happens, you see the likes of our farmers that are able to send less stuff over because the Americans won't buy it quite as much. At some point, that lower level of spending on exports, that means that, your farmer, they won't be able to buy, as many cars, as many fences. That'll then hit a New Zealand farm company who provides the fencing or the car or whatever. And so there's an implication of sort of flow-on effect that goes through.
Yeah.
It's not immediate and direct, but it does come.
And so whilst we're on the topic of KiwiSaver, I feel like I've seen this a lot lately, that people are changing their KiwiSaver fund because of what's going on at the moment. Yeah. So when markets are volatile, should people be changing their contributions with their KiwiSaver? Or is it similar to how we spoke earlier about depending what your strategy is?
I think it does depend on what your strategy is, and some people, again, when they're pretty game and gung-ho and they're happy enough to take a bit of risk, they might do both. They might look at changing their current settings and their risk. They might up their contributions and put a bit more money in there if they want to try it. But I think a lot of people probably that they should be sort of setting their KiwiSaver up generally for either the longer term, if that's their way inclined, or if they're looking shorter term, they probably should already be thinking earlier on, before the markets start to move in a volatile direction, over what do they want their sort of money to do. We do often see this reaction though. Every time there is a market downturn, every time there's more volatility, people worry quite understandably, and they go, oh, it looks down, I want to cut my losses before it gets any worse, and they change it. Again, I think that comes back to the take a breath idea. If you're already needing it to be a little bit more solid and stable, if you're buying a house, if you're looking to retire soon, you probably don't want it in something that's going to move heaps. And so I think we do see this all the time. The general rule is, one of the general rules that you often see people say is you don't want to move immediately, because in a sense you already should have moved before it changed, or you don't necessarily want to lock in the loss. Equally, there might well be a point where you go, look, I can't stomach this anymore. It's continued to get so bad that I do need to change. In that case, again, I think it's much better of an idea that you go and talk to some people, and probably an advisor or something, to go through and make sure that you're doing the best move for you rather than making a knee-jerk reaction. Yeah,
really good point. And I feel like that applies to not just when markets are volatile, right? Because I was going to say, I don't think I've ever looked at my contributions, so I don't know if that's a good or a bad thing.
And I mean, that's quite natural, though. I mean, the number of people that I know, particularly around our age group, that they don't. You know, it's a bit of a set and forget. Sometimes that can be a good thing. Sometimes it means that when there's an event in the global economy, you wake up and go, crikey, maybe I should look at this.
Yeah, maybe I should have actually looked at what I'm doing.
And I mean, the best advice, right, is that the best time to make a change with your finances was yesterday. The second best time is today. So sort of the sooner you get into it, the better. Be that starting up your KiwiSaver or your investment journey, or figuring out where you want the settings to be. And I think, again, that's often one where you find that happens when there's market volatility. It also might be when there are changes in your life.
I was going to say life events,
Yeah, huge one.
To look it up.
If you're changing jobs, if you're changing house, if you're changing areas, if you're getting into a new relationship, you've just ended a relationship, you're thinking about children, all those sort of things, you will want your money to move in different ways. You'll have a different risk tolerance. You know, when I'm completely by myself, I'm probably super keen for it to move all the places. If I was starting to get serious with a new partner or similar and she was like, hey, we're going to settle down soon, I'd probably be like, okay, I need to change my investment strategy.
Combining your finances,
And that's also why you find that, you know, particularly couples, you might have two very different investment styles. Sometimes that might work well, sometimes it might not. Communication is key here, both generally, I feel like, in relationships, but especially when it comes to investments.
Yeah, I feel like money conversations are really important.
Very tough. I mean...
hard to have, though, for
New Zealanders, I don't know if the rest of the world is like this, but certainly New Zealanders, we feel like it's a bit of a taboo subject.
It really is. Yeah.
But we've got to. And I think that's the big thing, is that as challenging as it might be, having that conversation after something's gone wrong and after something's changed, it's a whole harder conversation to have than doing it up front.
Yeah, absolutely. And I'm really curious, for new investors like myself, I'm in KiwiSaver, but I'm learning as I go through these episodes, and I am keen to start investing in other things. If they haven't yet, if they're like me and they haven't quite made that leap, but they're like 1 foot off the ground, they're about to, when markets are volatile in moments like this, would your advice be, don't start investing in something new right now? It doesn't seem like a smart idea. Or again, does it depend?
It does depend. I think it depends. Probably
part of me right now is like, no, just wait.
Well, there's an interesting bit here. I think it depends a little bit on your time scale. Like, if you're looking, again, that you need some money in, like, the next 5 minutes, then, yeah, I mean, now's a pretty tough one to make some money in this environment. Yeah. You could also make the argument, though, and some are at the moment, that when stock prices have come down quite a bit, you're almost getting a bit of a bargain. You know, you're buying at a low point. So...
Might be a good time.
Other people, again, would say, well, it could go lower. Also true. But I think it's more around that sort of time frame into the future. I think the biggest thing is, if I was someone who was starting out investing today, particularly in the volatile market that we have, and it is, would I throw all of my money in right today at, 4:29 p.m.? Absolutely not. But
you wouldn't do that anyway, would you?
Well, no, but some people do. Some people do. Or some people are keen to sort of they're keen to jump feet first in. I'm always way more of a fan, and I talk to a lot of friends about this, that when they start to get to this point of going, hey, I want to make some investments, take a little bit of money, and I'm not going to say play around in terms of be silly, but put it in a few areas just so you start to understand the market a bit in a low risk way. You don't want to sort of bet the house immediately, but I often have friends that, you might put some into the likes of exchange traded funds or similar, because that takes a lot of the hassle out of it. But you might also choose 3 or 4 companies that you think you know a bit about, that you think you understand why they might move, just so that you can understand those fluctuations. It might not be much. It might be $5 for each one. Just so you feel like you've got a little bit of, I should keep an eye on XYZ company. I've got $5 in it. I just want to figure out how it's moving. Does it normally move big? Does it move down? What are the things that are coming through? You might buy, I don't know, into, say, an apparel company that sells clothes. You might go, okay, well, if I'm hearing, market economists talk about how New Zealanders are buying fewer clothes, it's probably not good for my investment. You just start to make those connections between what's happening out in the economy and what it might mean for your investment at the time. But I wouldn't go sort of straight in. What we often also see, and I know that others talk about this a lot, is that, again, that idea of time in the market is more important than trying to timing the market. Right. And so you've often got the idea of the likes of dollar cost averaging. If you're putting, let's say, $50 a week in all the time, every single week, generally is going to do you better off than you sort of cracking the lines and going, I'm going to put a whole bunch in now and then do nothing for 4 months and then I'll try and pick the market. It's a lot of effort. It's a lot of time to go on the computer every day and sort of track the squiggly lines. Better just be constant and always do it. No, I don't have the time. I mean, I always find it funny. I think that people think that there are a lot of finance professionals out there who do, they're mad traders. Most of us are not. Most of us are looking at other bits of data or other things in the economy, and it is often way better, You just have something sort of regular to go through. It's sort of like eating breakfast. It just happens every morning. If you were to wait until you got hungry, you'd never know what sort of food you'd need. You're just sort of better to have it go and then you build up a bit of a routine.
I feel like that makes me feel so much better because I was kind of like, oh, now's not a great time to start my investing journey at the moment. I'm like...
Also, though, if you get yourself into the point of saying it's never a good time, it will never be a good time.
That's the thing as well, is I'm always someone that's like, coming up with a reason not to, and it's like sometimes it's just starting.
And you can argue it both ways, right? When the market's down, you can say, oh, it's not a good time because it could go lower. If you invest when it's going up, you're like, geez, pretty expensive time to get in. So you can argue it both ways. I think, put it this way, if you're already thinking about starting to invest, then when things are a little bit cheaper than otherwise, as long as you've got a long lead time, it's probably not the worst idea to, again, have a little bit, ease yourself into it. I'd never suggest jumping feet first into anything like that, but you can start to sort of build it up over time.
I knew you'd put a positive spin on it today, Brad. I knew. I feel like we're going to start calling you Good News Brad.
I've changed the name. This is very exciting. I feel so much better about myself as well now.
And for people that are really, really panicking right now, I think you've already touched on some great tips, but for people that are really stressed about it, do you have some good advice to kind of just talk them down?
Oh, look, it is tough. I think first thing is recognising that it's tough. A lot of times economists and other market commentators, we talk about this stuff like it's sort of not personal and it's not emotional. Like this is big bickies for some people. This is their money on the line. Yep. So just recognising that, this is a tough time. But again, I think the biggest part is you'd hate to make a rash decision and then regret two decisions. One, the fact of getting investing, and then the fact of changing it. So the first thing is just around sort of taking that breath. Having a look out as well at taking a bit of a step back. You might well have seen that your investments, have fallen over the last couple of weeks. They might still be up on where they were a year ago or 2 years back or similar. So do take that long-term view, because we do know that often there are cycles within the economy. There's some periods of volatility, but often we've seen a lot of growth as well the last couple of years. But it would be that sort of taking stock. What I'd probably do the first and foremost is sit down with whoever is in my trusted circle and talk about it. Maybe that's mum and dad, maybe that's some friends, it's the flatmates, the partner, heck, your children sometimes. Like, bounce these ideas off, because I think talking about it makes it a little bit less scary, makes you feel a little bit more in control. Probably write some stuff down, do some numbers. I don't know if, you might be an Excel spreadsheet person, you might be a sort of scribble it down on a notepad sort of person. There's a few different options. But again, doing that, you start to try and make those connections around, okay, is this sort of, big change? Is it not quite as big as I first thought? And I was just looking at all of the red ink and all of the numbers that are pushed through. Because let's be clear, the media at the moment is talking a lot about these challenges, and sometimes it feels very overwhelming.
It is daunting.
You might find that your investment's actually doing maybe not super well, but not as bad as it seemed to be from all of that reporting. So again, what does it mean for your current situation? What are you currently seeing in the numbers? And then going, look, if I did change, if that was what I sort of thought about, why would I be doing that? What am I changing it to? Am I going from super high risk to no risk at all? And I'll be sort of questioning myself and going, why was I super okay with it yesterday but not today?
180.
What's my actual level of risk? Like, am I quite a cautious person, in which case I was super keen when it was going really, really well, but when it goes bad, I immediately go, whoa. Yeah. In that case,
that's often people's approach, right?
Yeah. Oh, everyone's super keen on risk when it does well for them. But I think, it's people going through that sort of motion and going, okay, I'll sort of, let's just get this a little bit more sequenced. Let's get a bit more of a process in place, because there is so much emotion in this that if you can take a little bit out, if you can sort of just take a few breaths and you take that emotion out, I think generally you'll make a slightly better decision. So talk to some people, write it down so you feel a bit more in control. Figure out what options are there. I mean, you might sort of go, look, I want to have it into a more low-risk option. Does my KiwiSaver provider or whoever else it might be, do they actually provide that? What have they got on the books? What's the menu that I can choose from? Do I need to think about changing to another provider? How long is that going to take? Yeah. Because the markets might be moving a lot at the time, but, if my KiwiSaver change is going to take 2 weeks to go through...
Yeah, then it could change by the time those 2 weeks come through. Yeah.
And you might still want to do that, but at least you've got that information in your head to go, look, this is a decision I need to make, and if I make that decision, here are all the other things that are going to change with it. I feel like sort of, the more information you have, the better in control you will feel, and probably the better outcome that will come through. Even if it's a challenge at the end of it, the more information you have, the better you will make that decision. Yeah,
do a bit of research before just making that quick emotional reaction.
Often, I mean, no matter what it is, jumping feet first in can be a risky move. And I feel like for most people, when there's volatility, when there's big changes, doing that, it feels very uncomfortable to almost everyone I know. Some people love it. Some people love the thrill, but equally they've got to be willing to sort of take the challenge out the other end. And I think for the general person, it's a little bit easier to be a little bit more reserved, take that time, then make a good, well-informed decision that you're not going to feel like you've got as much regret on.
Thank you so much for your time today. I found that really insightful. If people are listening and they just found everything you said quite easy to understand, how can they learn more? Where can they listen to you if they want more information?
Great question. We do a lot of media interviews at Infometrics sort of across the board, be it sort of across the mainstream media, print, radio. Otherwise, I love appearing on the Fletchville and Haley show and with the ZM crew. But hey, I'm equally across ZB and any other combination of acronyms that you want when it comes to radio. Probably don't do as much as I should on my own social media, but I am on there. Brad Olsen NZL, I think it is. I post anything from my travel quizzes across the country through to sometimes some economic advice and sometimes through to the last thing I ate for brunch. So, a whole variety in there, but trying as well to make this sort of stuff relatable because let's be clear, this economics, the finance gig, it's often seen as way too complex, way too hard for people to break into. It is just another part of people's lives, and if we can sort of break those barriers down, and I try to do that when I have these sort of conversations and talk with other people, I feel like we'll all be in a much better place.
Yeah, I love that because it's a lot of why people don't invest as well. It's just it's too hard, can't understand it. And
we put up big barriers. It is scary, but I feel like if we can get through some of particularly if we cut out the jargon, cut out all the big words, get it down to absolute basics, when we're buying stuff, it's buying part of a company rather than shares and derivatives and options. And oh my God, I get sort of bored and lost and I feel like I should be trained in this stuff.
You shouldn't get bored.
No, if we can break this down to the absolute basics, and that's the biggest thing, that people understand it a bit more, they'll make better decisions.
Awesome. And don't panic about market volatility. That's the takeaway. Good news, Brad.
Look at it. You might worry about it, but take a breath.
Nice. Love it. Thank you so much. The content of this podcast is of a general nature and is not financial advice. The thoughts and opinions of guest speakers are not those of the FMA. The FMA recommends that our audience seek advice in respect to investing from a regulated financial advisor. The FMA does not accept any responsibility for loss that any person may suffer from following it.